Hey there, welcome to Money Nudge, where we make money talk simple. Let me ask you something. Have you ever wondered why your credit card balance grows so fast? Or why your savings account barely grows at all? Why does the bank charge you for borrowing money but pay you when you save it? What is that little percentage number behind all of this? That's called the interest rate. So, what is an interest rate? At its core, an interest rate is the price of money. That's it. So simple, right? If you borrow money, the interest rate is the price you pay to use someone else's money. If you save or invest money, the interest rate is the reward you earn for letting someone else use your money. Think about it like renting. If you rent an apartment, you pay rent to live there. You're using someone else's property. When you borrow money, you're basically renting money. The interest rate is the rent you pay. Let's make it super simple. Imagine you borrow $1,000 from a bank at a 10% interest rate for 1 year. 10% of $1,000 is $100. So after 1 year, you owe the bank $1,100. You borrowed $1,000. You paid $100 for the privilege of using that money. That $100 is interest. The 10% is the interest rate. Now flip it around. Let's say you deposit $1,000 into a savings account that pays 5% interest. After 1 year, you earn 5% of $1,000, which is $50. Now you have $1,050. In this case, the bank is borrowing your money, and they're paying you for it. So why do interest rates even exist? Because money has value over time. This idea is called the time value of money, and it's one of the most important concepts in finance. Money today is worth more than money tomorrow. Why? Because if I give you $1,000 today, you could invest it, start a business, buy inventory, or earn returns on it. If I wait 1 year to give it to you, you lose that opportunity. Interest is basically compensation for time. Now let's talk about where interest rates show up in real life. First, loans. When you take out a car loan, mortgage, student loan, or use a credit card, there's an interest rate attached. The higher the interest rate, the more expensive that loan becomes. For example, if you buy a $300,000 home with a 3% mortgage rate versus a 7% mortgage rate, the difference over 30 years can be tens or even hundreds of thousands of dollars. Second, savings accounts and investments. When interest rates in the economy rise, banks usually increase savings account rates. You might see 4% or 5% yields instead of 0.5%. That means your money grows faster without you doing anything. Third, businesses. Companies borrow money too. If interest rates are low, it's cheaper for businesses to expand, hire, and invest. If rates are high, borrowing becomes expensive, and companies slow down. That's why interest rates affect the entire economy. And that brings us to a big question. Who decides interest rates? In the United States, short-term interest rates are heavily influenced by the Federal Reserve, also known as the Fed. The Fed doesn't directly set your credit card rate, but it sets a benchmark rate that influences the entire financial system. When the Fed raises rates, borrowing becomes more expensive. When the Fed lowers rates, borrowing becomes cheaper. This is how the Fed tries to control inflation and stabilize the economy. If inflation is too high, they raise rates to slow spending down. If the economy is weak, they lower rates to encourage borrowing and growth. Interest rates are basically the volume knob of the economy. Now, here's another key idea you'll hear all the time in finance: risk. Here's the deal. The riskier the borrower, the higher the interest rate. Why? Because lenders want to be paid more for the chance they might not get their money back. Think about it like this. If you lend money to the US government, pretty safe, right? They're not going anywhere, so the rate is low. But if you lend money to a brand new startup with shaky cash flow, yeah, you're going to want a much bigger reward for taking that risk. Okay, let's bring this all the way home. How does this actually show up in your everyday life? Honestly, everywhere. Your mortgage payment? Interest rate. Your car loan? Interest rate. Your credit card balance? Interest rate. Your savings account? Yep, that too. Even your investment returns. And believe it or not, the job market and housing prices feel it as well. Here's the simple takeaway. When rates go up, borrowing slows down. When rates go down, borrowing speeds up. The whole economy moves with that little number. So even if you're not thinking about finance every day, trust me, finance is absolutely thinking about you. All right, let's do a quick recap. An interest rate is the price of money. If you borrow money, it's what you pay. If you save or invest money, it's what you earn. Interest exists because money has value over time. It affects loans, savings, businesses, and the entire economy. It's influenced by central banks like the Federal Reserve. And it can either build wealth through compound growth or destroy wealth through high-interest debt. And that's it. Now you understand what an interest rate is and why it matters. You just got a money nudge. Hit that like button and subscribe. And we'll keep making money make sense one video at a time.